Economic crashes are sold to the public as disasters. We're told they're unpredictable storms that devastate everyone in their path, wiping out savings, destroying jobs, and leaving entire communities in ruins. But here's what history actually shows. For a small group of people, crashes aren't feared at all. They're anticipated, they're welcomed, they're profitable beyond measure. Think about that for a moment. If crashes truly destroy jobs, obliterate savings, and shatter economic stability, why do the wealthiest families, the largest funds, and the most powerful institutions always seem to emerge from these disasters not just intact, but stronger than before? Why does every major economic collapse somehow result in greater concentration of wealth at the top? What if I told you that economic crashes aren't system failures at all, but rather system features, working exactly as intended for those who understand the rules? Let's start by addressing how these crashes are usually explained to us. You've heard the narratives 1,000 times: greed, unbridled speculation, panic selling, poor regulation, black swan events that nobody could have predicted. And look, there's truth in all of these explanations. Markets do become irrational, people do panic, regulations do fail to keep pace with innovation. These factors absolutely exist and contribute to economic volatility, but here's what these explanations conveniently leave out. They tell us nothing about who benefits. They focus entirely on the chaos, the fear, the collapse, without ever examining who's positioned to capitalize on that chaos. They treat crashes as democratic disasters that hurt everyone equally, when the historical record shows the exact opposite. There's a fundamental imbalance in how crashes are experienced. For ordinary people, crashes represent pure chaos: lost jobs, foreclosed homes, evaporated retirement accounts. But for large capital, for those who truly understand how the system works, crashes represent something entirely different. They represent clarity, they represent opportunity, they represent the moment when assets can be acquired at basement prices from desperate sellers who have no choice but to liquidate. So, what do the wealthy see during these crashes that everyone else is blind to? What structural advantage allows them to not just survive these storms, but to use them as launching pads for even greater accumulation? To understand this, you need to grasp the first hidden law of economic crashes. Crashes don't destroy wealth, they transfer it. This is the foundational truth that changes everything. When markets collapse and trillions of dollars in market value seemingly vanish into thin air, that wealth hasn't actually been destroyed. It's moved, it's changed hands, it's been redistributed from those who were forced to sell at the bottom to those who had the resources to buy. Look at every major crash in modern history, the pattern is identical. Stock prices plummet, real estate values crater, businesses fail, and their assets go to auction. And in every single case, what happens? Ownership consolidates. Fewer players control more of the economy afterward than they did before. The crash doesn't eliminate the assets themselves. The factories still stand, the real estate still exists, the profitable business models still work. What changes is who owns them. Crashes are liquidation events, pure and simple. They force a massive repricing of assets and a wholesale transfer of ownership. And here's the critical insight: liquidation always favors those who are not forced to sell. When you understand this, you stop seeing crashes as random disasters and start seeing them as mechanisms that systematically concentrate economic power. This brings us to the concept of liquidity, which is really just a fancy word for financial staying power. Liquidity means having cash on hand. It means having access to credit when everyone else is being cut off. It means having the luxury of patience, the ability to wait out the storm while others are forced to sell at fire sale prices just to survive. Now contrast two positions during a crash. First, consider the leveraged position. This is where most people find themselves: workers living paycheck to paycheck with no savings cushion. Small investors who took out loans to buy stocks or real estate, businesses that depend on constant revenue to make their debt payments. These are the people and entities that get absolutely crushed during crashes. They have monthly obligations that don't stop: mortgages, car payments, payroll, debt service. When income streams suddenly dry up during a crash, they have no choice. They must sell whatever they can at whatever price they can get, even if it means taking devastating losses. Now consider the liquid position: large investment funds sitting on billions in cash reserves, old family wealth that's been prudently managed across generations, institutions that have structured themselves to always have dry powder ready for exactly these moments. These entities don't have the same desperate need to sell. They can afford to wait, they can afford to be patient, they can watch assets fall to a fraction of their previous value, and then calmly step in to acquire them at prices that will seem absurd in retrospect. Crashes don't reward intelligence, despite what we're often told. They don't reward hard work, they don't reward innovation or entrepreneurship. They reward one thing above all else: whoever can wait, whoever has the financial resources to endure the storm without being forced into desperate action. And the entire financial system is structured to ensure that this staying power is concentrated in very few hands. This leads us to the second hidden law. The wealthy don't fear volatility, they need it. This is where we shift from understanding crashes as defensive events to understanding them as offensive opportunities. For most people, volatility is terrifying. When markets swing wildly, when asset prices become unpredictable, when economic stability evaporates, ordinary people experience this as pure danger. Their jobs become uncertain, their savings become unreliable, their ability to plan for the future disappears. But for large capital, volatility is the entire game. Here's why. Stable markets preserve existing positions. When prices are steady, when growth is predictable, when conditions are calm, it becomes very difficult for large capital to expand its holdings cheaply. In stable times, assets trade at fair value or even premium prices. There are no desperate sellers. There are no undervalued opportunities. The economic pie might be growing, but everyone's slice grows proportionally. Crashes change everything. Crashes create an environment where assets can be acquired at massive discounts. They create distressed sellers who will accept any reasonable offer. They create political urgency that leads to extraordinary interventions that almost always benefit large capital holders. Without periodic crashes, without these moments of chaos and repricing, large capital cannot expand its share of the economy at the rate it requires. Think about what crashes consistently produce. Cheap assets across every category, distressed sellers desperate for any liquidity, political leaders demanding action and willing to bend or break normal rules to restore stability. This isn't a disaster for those positioned correctly. This is exactly the environment they need to massively expand their economic footprint. To understand why crashes are so devastating for most people, we need to talk about debt and leverage. In modern economies, debt is everywhere. Mortgages, student loans, car payments, credit cards, business lines of credit. And debt comes with a fundamental vulnerability. It requires constant servicing. Monthly payments don't stop. Interest accrues regardless of your circumstances. Debt demands predictability and continuous cash flow. When crashes hit, they systematically destroy that predictability. Income streams that seem stable suddenly evaporate, jobs disappear, business revenue collapses, investment income dries up, and the debt remains. Every dollar owed must still be repaid. This is what triggers the cascade of forced selling. People who took out mortgages must sell their homes before foreclosure. Investors who bought stocks on margin get margin calls and must liquidate positions immediately. Businesses that borrowed to expand suddenly can't make payroll and must sell assets or declare bankruptcy. Meanwhile, those who avoided excessive leverage, who kept their balance sheets conservative, who maintained liquidity, they face no such pressure. They can hold their positions, they can weather the storm, and more than that, they can deploy their reserves to acquire assets from all those forced sellers at prices they would never accept in normal times. Crashes reveal a fundamental truth that gets hidden during boom times. They show who actually owns what versus who merely borrowed it and holds it temporarily. Debt is a claim on future earnings, and when those earnings disappear, the debt becomes a mechanism for transferring ownership to those who hold the claims. This brings us to perhaps the most important hidden law. Crashes justify extraordinary interventions. There's a pattern that repeats in every major economic crisis. The crash hits, panic spreads, and then governments and central banks step in with measures that would be politically impossible during normal times. Emergency powers are invoked, trillions in public money are deployed. Rules that existed for decades are suddenly suspended in the name of stability. And who benefits from these interventions? Almost invariably, it's the institutions deemed systemically important, the banks too big to fail, the investment funds whose collapse would supposedly trigger broader disaster, the asset owners whose losses must be protected to prevent contagion. The pattern is remarkably consistent. Profits during good times are privatized and flow to shareholders and executives. But when crashes hit, losses are socialized and absorbed by taxpayers. Crashes create a political environment where actions that would spark outrage during calm times can be implemented with broad support. People are scared, they're desperate for leadership, they're willing to accept almost any intervention that promises to restore stability. And this is when the real restructuring happens, when policies that permanently advantage large capital can be locked in while everyone is focused on the immediate crisis. So let's bring this all together. Economic crashes are not failures of capitalism. They are how capitalism clears, consolidates, and concentrates ownership. They are the system's reset button, the mechanism by which economic power periodically reconsolidates at the top. Every hidden law we've discussed points to the same conclusion. Crashes systematically transfer ownership from the many to the few. They transfer ownership by forcing leveraged sellers to liquidate while liquid buyers accumulate. They reward those with financial staying power while punishing those living on the edge. They create opportunities for large capital to expand its footprint cheaply. They justify interventions that protect existing capital holders, and they concentrate control in fewer and fewer hands with each cycle. Look at the aftermath of any major crash. Fewer independent businesses and more consolidation under large corporations. Fewer individual property owners and more institutional landlords. Fewer autonomous economic actors and more dependence on massive institutions. Each crash advances this process, and the inequality gap widens not despite crashes, but because of them. So, what does this mean for you? Most people are taught to fear crashes emotionally, to panic when markets fall, to see these events as random disasters that disrupt otherwise stable systems. But almost nobody is taught to understand them structurally, to see the mechanisms at work, and to recognize the patterns that repeat throughout history. Crashes don't ask who worked hardest. They don't reward moral virtue or personal responsibility. They ask one question: who was positioned correctly, who had the liquidity, the patience, the structural advantages to not just survive, but to capitalize on chaos? If this reframed how you see money, power, or economic crisis, subscribe to the channel. You're beginning to understand something fundamental about how our system actually works. History doesn't hide these rules. We just aren't taught to look for them. But once you see them, you can't unsee them. And that changes everything.